Everyone wants to know the secret to beating the market, the hidden formula, the next big trade, the shortcut to wealth. But the truth is almost disappointing in its simplicity. The less you do, the more you earn. Real investing isn't about chasing excitement. It's about mastering patience, because the market doesn't reward brilliance, it rewards discipline. And those who learn to stay the course, keep costs low, avoid speculation, and think in decades, not days, discover that time, not timing, is the real secret to wealth. Stay the course. Those three words sound simple, almost too simple, but within them lies the difference between success and regret for most investors. Markets move like the tides. They rise, they fall, sometimes calmly, sometimes violently. The mistake most people make is trying to predict those tides, thinking they can leap in at the perfect moment and step out just before the waves crash. But time and time again, history proves that even the most brilliant minds cannot do that consistently. The truth is uncomfortable, but liberating. You don't need to time the market to succeed. You need only to hold your ground when the storms come. When markets fall, fear takes control. Headlines scream, portfolios shrink, and every instinct says get out before it gets worse. When markets soar, greed whispers, buy more. This time is different. Both emotions, fear and greed, are enemies of long-term success. The key is to anchor yourself to a plan that doesn't bend with every gust of market wind, because the market's short-term movements are nothing more than noise, and reacting to noise almost always costs you more than standing still. The real test of an investor isn't when things go well, it's when the world looks uncertain and everyone else is running for the exits. Staying the course doesn't mean ignoring reality. It means understanding it. Markets are built to fluctuate. The very nature of investing guarantees temporary declines on the road to long-term growth. Yet, those who hold their investments through those declines are rewarded not because they are smarter, but because they are patient. In the long run, the market is a reflection of human progress, of businesses creating value, of workers producing, of innovation pushing forward. And that march of progress doesn't stop because of a quarter's bad earnings or a year's panic. Those who stay invested through the noise participate in that progress. Those who jump in and out miss the compounding miracle that only time can deliver. There's an old saying, the market is a device for transferring money from the impatient to the patient. Every major downturn in history, from crashes to recessions, has tested this principle. Investors who sold in fear locked in losses. Those who stayed in their seats eventually saw a recovery and growth beyond what they imagined. It's not a matter of luck, it's a matter of discipline. Staying the course means you accept that you will feel uncomfortable sometime, you will doubt yourself, you will question your choices, but you hold steady because you understand that volatility is not the enemy, reaction. Over the decades, compounding rewards those who endure. The difference between a short-term trader and a long-term investor isn't intelligence, it's temperament. The long-term investor builds wealth slowly, quietly, without drama. They resist the temptation to trade on emotion or follow the crowd. They recognize that time is the greatest ally of compounding and that abandoning the plan destroys that partnership. So stay the course. Don't let the daily noise dictate your destiny. The market will always fluctuate. That's its nature. Your job is to endure, to trust in the long-term growth of enterprise and the power of patience. Hold your ground, and the passage of time will do the heavy lifting. Minimize costs. It sounds like such a small thing, but over a lifetime investing, it becomes the most powerful difference between those who merely participate in the market and those who truly prosper from it. Every dollar you pay in fees, every fraction of a percent in expense ratio is a dollar that can never work for you again. That dollar doesn't compound. It doesn't earn dividends. It doesn't grow. It leaves your pocket and enters someone else's, often quietly and invisibly. The great irony of investing is that you can do almost everything right, choose good funds, hold them for decades, yet still underperform simply because of cost. The math of investing is mercilessly simple. The more you pay, the less you keep. The financial world thrives on complexity. It's built to make you feel like you need more management, more strategy, more trading, more advice. But every layer of more usually comes with a fee, and that fee compounds against you. Small annual expense, say 1 or 2%, may seem trivial, but over 40 years it can consume almost half of your total potential gain. That's the silent killer of returns. The market can give, but cost can quietly take it away. So the simplest way to improve your long-term performance isn't to outsmart the market, but to stop overpaying for the privilege of participating in it. People often chase high-cost funds because they believe they're paying for skill, but the evidence tells a different story. Over long periods, most actively managed funds fail to outperform the very markets they track. The reason isn't lack of intelligence or effort, it's cost. The higher the fee, the higher the hurdle that must be overcome just to match the return of a low-cost alternative. And in investing, where even a single percentage point compounds enormously over time, that hurdle is steep. Keeping costs low is an act of humility. It's admitting that the market's collective wisdom, millions of buyers and sellers setting prices every second, is hard to beat consistently. So instead of trying to outguess it, you participate in it at the lowest possible cost. You own a piece of the entire market and let capitalism work for you. When you eliminate unnecessary fees, you tilt the odds in your favor. You stop trying to extract a miracle and start letting the natural power of compounding do what it's meant to do. Cost is the one thing you can control. You cannot control market returns. You cannot control economic cycles or government policy, but you can control how much you pay. And when you control that, you tilt the long-term outcome dramatically in your favor. The investor's greatest advantage isn't timing, insight, or prediction. It's efficiency. Keep it simple, keep it cheap, and keep it steady. Because in the end, every penny saved from cost is a penny that compounds for you, not for someone else. And over a lifetime, that makes all the difference between hoping for wealth and actually achieving it. But keep it simple. In a world obsessed with cleverness, simplicity often feels underrated, even unfashionable. Yet in investing, simplicity is not a weakness. It's a strength. Complexity disguises risk, hides cost, and feeds ego. Simplicity, on the other hand, shines a light on what really matters, owning a diversified portfolio, keeping costs low, and letting time and discipline do their quiet work. The most powerful investment strategy is not one that dazzles with charts or promises secret edges. It's the one that works predictably over decades, not days. Simplicity doesn't promise excitement, it promises results. Investors often believe that success requires brilliance, that there must be some formula or algorithm that can outsmart the market. That's what the financial industry sells, complexity dressed up as expertise. Yet the more complex a portfolio becomes, the greater the opportunity for error. More moving parts mean more decisions, and every decision opens the door to emotion, timing, mistakes, and cost. You can diversify across hundreds of funds, own dozens of strategies, and still end up doing worse than the investor who quietly owns a single broad, low-cost index fund and holds it. Complexity doesn't add control, it adds confusion. The truth is, markets reward patience and discipline far more than they reward intellect. The idea of owning a broad, diversified portfolio, one that mirrors the entire market, is both profoundly simple and profoundly effective. When you hold the whole market, you own every winner automatically and you limit the damage of every loser. You stop trying to guess which company, sector, or country will outperform because you already own them all. And you do it at the lowest possible cost. That's the essence of simplicity. You stop trying to be smarter than everyone else and focus instead on not making mistakes. Complicated strategies often fail because they demand constant tinkering. You buy one stock, sell another, shift allocations, chase trends, respond to headlines, all in the hope of improving your outcome. Yet every adjustment invites new costs, new taxes, new chances to be wrong. The simple investor avoids this trap by doing less. Paradoxically, doing less often produces more. By limiting decisions, you eliminate noise. By holding broadly diversified, low-cost investments, you allow the natural growth of business and the global economy to lift your portfolio over time. Simplicity also builds emotional strength. When you understand your investments, when you can explain your plan in one sentence, you're less likely to panic when the world gets loud. Complexity feeds anxiety because you can't see all the pieces moving. But when your plan is simple, transparent, and consistent, you can stay calm when markets swing. Simplicity gives you clarity, and clarity gives you confidence. The greatest investors understand that the hardest thing is not finding a complex formula, it's sticking with a simple one. The market doesn't reward constant activity, it rewards consistency. So keep it simple, own the market, keep costs low, stay disciplined, and let time do the work. Because in the end, the simple path isn't just easier, It's the most effective path to lasting wealth. Avoid speculation. Investing and gambling may look similar on the surface. Both involve money and uncertainty, but their foundations couldn't be more different. The investor buys ownership in real businesses that create value over time. The speculator buys a ticker symbol, hoping someone else will pay more for it tomorrow. One builds wealth through patience and production. The other bets on emotion and luck. The distinction matters because the moment you cross from investing to speculation, you trade long-term compounding for short-term excitement, and that excitement almost always ends in disappointment. Speculation thrives on stories, noise, and prediction. It feeds on the illusion that if you just watch closely enough, or read the right headline, or follow the right expert, you can stay one step ahead of everyone else. But the market doesn't work that way. Prices already reflect the collective intelligence of millions of participants, all acting on the same information. To think you can consistently outguess that is to believe you are smarter than the crowd every single day. It's a dangerous illusion. The real key to building wealth isn't prediction, it's participation. You participate by owning businesses, holding them through thick and thin, and letting time and productivity work in your favor. Speculation is seductive because it promises control. It makes you feel active, engaged, even brilliant when a quick trade works in your favor. But it's a game of odds, not insight. Eventually those odds catch up. The problem isn't that you'll never win a speculative bet. It's that you'll win just enough to believe you can keep doing it. Over time, transaction costs, taxes, and emotional decisions erode whatever small victories you collect. The more you trade, the more you pay, and the less you compound. The investor understands that wealth doesn't come from trading quickly. It comes from owning patiently. True investing is rooted in reality. When you buy a share of a company, you buy a piece of its future earnings, its innovation, its people, and its ability to grow. A company may stumble, the market may wobble, but over years, productive businesses expand, pay dividends, and deliver value. That's the foundation on which wealth is built. Speculation ignores that foundation. It treats the market like a casino rather than a system of ownership. But the stock market is not a casino, it's a mechanism for channeling capital into enterprise. Confuse the two, and you risk turning your savings into chips on a table. Avoiding speculation means accepting that the future cannot be known in advance. It means having the humility to say, I don't know where the market will go tomorrow, and I don't need to. The long-term investor doesn't need to guess, they need to endure. They buy real businesses, not stories. They hold them not because of today's headlines, but because of tomorrow's potential. The market will tempt you to gamble, it always does, but resist it, because every moment spent guessing is a moment not spent compounding. In the end, wealth doesn't come from guessing right, it comes from owning right. Think decades, not days. That simple shift in mindset separates the speculator from the true investor. The difference between winning and losing in the market isn't usually intelligence or access, it's perspective. Most people look at the market through a microscope, reacting to every movement, every headline, every fluctuation as if their future depends on it. But those who succeed see the market through a telescope. They look far beyond today's noise and recognize that wealth isn't built in days or even years. It's built through decades of patience, consistency, and time. Time is the most powerful force in investing, yet it's the one thing most people refuse to give. They want results now, comfort now, certainty now. But markets don't move on our schedules, they move in cycles, sometimes rewarding patience quickly, sometimes testing it for years. The beauty of long-term investing is that time transforms volatility into growth. What looks like chaos in the short run often resolves into progress over the long run. Stocks rise and fall, economies expand and contract, but the long arc of human enterprise bends toward advancement. Businesses innovate, productivity improves, and value accumulates for those who stay invested long enough to witness it. The greatest advantage any investor can have isn't superior analysis, it's time. Time allows compounding to work its quiet magic. A dollar invested today doesn't just grow, it grows on itself, multiplying year after year, decade after decade. But compounding only rewards the patient. Interrupt it with short-term reactions, jumping in and out, chasing trends, fleeing fear, and you reset the process over and over again. The investor who stays invested through thick and thin allows their returns to compound without interference. The speculator who constantly trades cuts the compounding short before it ever reaches its potential. Thinking in decades also means accepting discomfort. There will be times when your investments fall in value, when the headlines scream that the end is near, when doubt whispers that maybe you should have done something different. But those moments are the price of long-term success. If you cannot endure the short-term pain, you cannot earn the long-term reward. Every great bull market in history has been born from moments of despair. Those who had the patience to stay through the storm saw results that those who fled never experienced. Short-term noise is your enemy, not because it's always wrong, but because it distracts you from your plan. The market's daily fluctuations are nothing more than the opinions of millions of people trying to guess the future. None of them know, and neither do you. But you don't need to know tomorrow's price to build wealth. You only need faith in the enduring strength of productive enterprise and the discipline to give it time. So think decades, not days. Let time be your ally. Ignore the noise, stay the course, and trust the process of compounding. The years ahead will bring ups and downs, but for those who remain patient, time will turn those fluctuations into progress, because in the end, time, not timing, is what builds true wealth. So if you remember those three words, costs, discipline, time, then you have the framework. Choose low-cost vehicles, stay disciplined to your plan, invest for the long term, let the market do what markets do, rise over the long haul, even though the short term is noisy. Before I leave you, let me address one more thing. Emotion, fear, and greed are potent. They will whisper that you should buy the hot fund, pick the next star manager, or jump ship when the market drops. But I caution, the greatest enemies of the investor are often expenses and emotions. If you pay high cost, you lose. If you act emotionally, you lose. If you try to outsmart the market, you still pay. So instead, adopt the humility of the simple investor who knows, I own broad markets, I keep costs low, I stay invested, and I give time to do its work. Let me end with this thought. You are not in this for seasonal excitement. You are in this for lifetime results. You are building a future, and being consistent is far more powerful than being brilliant. Far more powerful than being right once it's being right over time. So control your costs, stay disciplined, invest across time. Do that, and you will not just participate in the market, you will own your future. Thank you for listening. The climb is long. Your backpack need not be heavy. Pack 3 words: costs, discipline, time, and head upward.